Delayed inflation numbers were shared today in the U.S. The Personal Consumption Expenditures Price Index came in at 2.8% for September. Let's discuss with Michael Green, Chief Investment Strategist, Simplify Asset Management. Thanks for joining us today.
It's a pleasure to be here.
So it's the last reading the Federal Reserve gets before it makes an announcement next week. But how much does it matter considering the information from September?
Yeah, I don't think it matters very much at all. I think the Fed is highly likely to cut. We've been told this by multiple members of the Federal Reserve. This will be another hawkish cut in which they indicate that very well they may pause and not continue. The simple reality is that the inflation data is muted relative to the runaway expectations people had earlier in the year. Now we're starting to see increased concerns around the labor market that will lead the Fed to cut.
Talk to me about the concerns around the labor market, again, because official data has been delayed, and they're not going to get the most recent data until after they make their announcement.
Well, they've indicated that they're very closely watching private sector data. We got data from Revelio. We got data from ADP that is current. Both of those suggest that the economy is weakening, that the labor force is weakening. There are some positive developments. Again, we have delayed data that's coming out from the official sources about the composition of jobs in the United States. There does appear to be a bit of a rebound in employment for those who were born in the United States, which has been one of the objectives of the Trump administration. That remains to be seen. We'll see if that process continues, but the private sector data is telling us that the economy is weakening.
Okay, because it is so highly expected that the Federal Reserve will cut, do you anticipate it to move the markets?
I don't think it's going to meaningfully move the markets. I do think the language that is used, depending on how hawkish the speech after the release is and the language that accompanies the release, how hawkish that ends up being, that could lead to somewhat of a backup in long end yields. But I think the most important component that people have now realized is that long end yields are not running away from the Fed. This is not an issue of if they cut, then we're going to end up with 6 or 7% 10-year yields. There are scenarios in which that can happen, but they seem implausible given the current status of the economy.
Okay, we have seen more volatility lately through tech stocks, generally moving out of money or moving money more across the board. Do you expect volatility to continue through the end of the year?
Well, I think what we're seeing right now is a little bit of a tug of war. So some of the leading stocks have started to lose some momentum. People have backed away from the idea that the only answer is to buy the Mag 7. We're seeing, and you're seeing this in Canada's markets as well, we're seeing late stage cyclicals, we're seeing things like energy, et cetera, begin to benefit a little bit. We've seen commodities rally. Those tend to be either early stage, which could indicate a recovery in the United States. We've effectively had a near manufacturing recession for roughly 2 years in the United States. I know Canada has suffered alongside us in that front. If we are actually at a point at which the cyclical portion is rebounding, that would be one explanation for some of the stuff that we're seeing. The other component is simply that it's late cycle. People are looking to rotate. They're not sure what direction it's going. And the very large sums that can come out of a company like NVIDIA to effectively buy the entire small cap index at a similar market capitalization suggests that rotation could continue for a little bit, giving us the volatility that we've been experiencing.
Okay, consumer sentiment seems to be slightly better now than it was. Considering the weakness in labor, why do you think that is?
Well, I think it's a combination of factors. One, the fears about inflation have begun to back off. That's one of the key components that jumps out of the Michigan survey, which, I think it has its methodological issues. We got to be very careful in how we interpret it. But it does suggest that conditions have improved slightly, both around expectations of inflation. And as I indicated, some elements of job losses appear to be concentrated in the immigrant community in the United States. We are seeing rising native-born employment. We would expect that to show up in consumer sentiment as it appears to be doing so.
Okay. Do you think, considering the numbers from sort of Black Friday, Cyber Monday, that weekend in between, what you're seeing with consumer sentiment, does that bode well for Christmas retail?
Well, I think what we're seeing, unfortunately, is far less discounting. Inventories have gone into the end of the year at much lower levels than they did last year, where the fears of tariffs effectively pulled forward a lot of spending. Unfortunately, we're seeing an uptick in the usage of credit, whether that's credit cards or buy now, pay later, that suggests that people are hopeful and therefore spending a reasonable amount, but the absolute quantities that people are buying are not nearly as robust as what we're seeing in the pricing components, which reflects much lower discounting this year.
All right. Let me ask you about what your strategy is for year end and starting into next year. How would you advise investors?
Well, the point that I continue to emphasize for people is when you see fixed rates back up, when you see the 10-year moving significantly above 4%, as it roughly is today, by and large, that represents an opportunity to lock in real yields that most of us have not seen for a very, very long period of time. I'm skeptical about valuations in the equity markets. I'm very aware that they remain highly contingent on employment in the United States. And so I'm nervous about the equity markets. I'm opportunistic in the fixed income markets.
All right. I will leave it there with you, Michael Green. Appreciate you joining us on the program. Thank you.